You know, if you walk into a modern intensive care unit, you don't just see a doctor standing over a patient with a stethoscope anymore.
Right, it's just screens everywhere.
Exactly. It's an absolute wall of digital monitors. I mean, the EKG machine is tracking the heart rhythm. You've got the pulse oximeter monitoring blood oxygen. There's a highly specialized feed for the ventilator, and even automated IV drips, right? Measuring fluid intake down to the milliliter. It's a brilliant, highly calibrated symphony of diagnostic data.
It really is.
But imagine for a second that the EKG machine outputs its data in French.
Oh, man.
And the ventilator strictly uses Russian, and then the pulse oximeter only outputs raw, unformatted binary code.
It sounds like a complete nightmare.
Right. And this attending physician is just standing there trying to manually translate and correlate all of this disparate information in their head.
While the patient is crashing?
Exactly. While the patient is actively crashing on the table.
That's a terrifying clinical scenario.
Yeah.
But it's actually a surprisingly accurate depiction of what the underlying infrastructure of the digital economy has looked like for, well, the past decade.
Yeah.
It's the architectural reality that almost every major enterprise has been dealing with.
And it is an incredibly expensive reality, too. I mean, when you have applications running in distributed cloud environments and legacy on-premises mainframes that just refuse to die.
They never die.
Right. Plus, AI models suddenly generating code on the fly and billions of telemetry data points firing every single second. Finding the root cause of an outage and all that isn't just looking for a needle in a haystack.
No, it's not.
It is looking for a specific, slightly bent needle in a haystack made entirely of other slightly different needles.
That is the absolute definition of diagnostic friction. And, in the enterprise software world, friction doesn't just cause headaches, it causes catastrophic financial bleed.
Right.
I mean, when you are a multinational bank or a global logistics firm, that diagnostic friction costs you millions of dollars every single minute your core systems are offline.
Millions, exactly. And that diagnostic friction, and more importantly, the company attempting to completely eradicate it, is our focus today.
Yeah, let's get into it.
Welcome to this deep dive. For those of you listening, our mission today is incredibly focused. We are taking the dense Wall Street jargon of Datadog's Q1 2026 earnings call,
which is a long one,
a 50-minute management presentation packed with complex financial engineering and, frankly, highly technical product updates. And we are translating it into a data-forward, opinionated, and highly actionable talk-ticker-style briefing just for you.
We're breaking it all down.
We are. We're looking at the raw numbers, the underlying architectural shifts driving those numbers, the management team's guidance, and ultimately whether this translates into a definitive bullish or bearish signal for you, the retail investor, based purely on the evidence.
Because the reality is, you're busy. You don't have time to parse through 50 minutes of corporate speak.
No one does.
Right. You need to know if the thesis on cloud infrastructure consolidation, and obviously the AI training boom, is actually holding up in the real world.
Right. Like, are they actually signing enterprise contracts, or is it just surviving in the hype cycle of press releases?
Exactly. So here is the blueprint for how we're tackling this today.
Lay it out.
First, we're going to hit the headline numbers. Revenue, EPS, margins.
Big stuff.
Yep. Second, we're diving into the story behind those numbers. What are the actual business drivers? Third, we look at management's guidance for the future. And fourth, the bottom line. Bullish or bearish?
I love it. And I want to jump straight into section 1, the top line performance.
Yeah.
Because Datadog just crossed this massive psychological and financial milestone that honestly fundamentally alters how Wall Street values them.
Oh, absolutely.
Q1 2026 revenue hit $1.01 billion, a 32% year-over-year increase. This is the very first time this company has crossed the $1 billion mark in a single 90-day quarter.
Crossing that $1 billion quarterly threshold it's rarefied air.
It really is.
It transitions a software company from being just another high-growth disruptor into a foundational pillar of the broader economy. But the raw $1 billion figure isn't actually what caused analysts to scramble to update their models.
Right. It's the velocity at that scale. I was looking at the quarter-over-quarter trends, and the growth rate actually accelerated.
Which is wild.
It is. They hit 32% year-over-year growth this quarter. Last quarter, it was 29%.
Right.
And the quarter before that, in the same period last year, it was 25%. So as the revenue base expanded massively, the physical speed of the company's expansion also increased.
Yeah.
From a, I guess, financial physics standpoint, how do we even contextualize that?
I mean, it completely defies the standard law of large numbers.
Usually growth slows down, right?
Yep. Exactly. Usually, as a software as a service company scales, gravity takes hold. The bigger the denominator gets, the harder it is to maintain those high percentage growth rates.
Sure.
Growing a $10 million book of business by 30%, you just need to sign a few good deals.
Right.
Growing an $800 million quarterly baseline by 32%, that requires a systemic, industry-wide adoption of your platform.
Oh, that makes sense.
Acceleration at this scale, it just proves that their total addressable market is actually expanding faster than their ability to penetrate it.
And it's not just like one-off professional services or hardware sales padding that revenue either.
No, not at all.
Their total annual recurring revenue, their ARR, now exceeds $4 billion.
That's a huge base.
It's massive to have that kind of recurring revenue base locked in and to see the growth rate of that base steepen from 25% to 29% and now 32%. It tells me that market saturation isn't even on the horizon yet.
Not even close.
But I have to play devil's advocate here for a second.
Go for it.
We've seen hypergrowth tech companies post these kinds of top-line numbers before, particularly, during the zero interest rate era.
Oh, yeah. The free money days.
Right. And usually they achieve it by burning capital indiscriminately. They essentially just buy revenue at a loss.
Exactly.
But Datadog's profitability metrics look like they belong to a mature, slow growth utility company.
That is the structural anomaly of Datadog. I mean, they are pairing hypergrowth with extreme capital efficiency. Let's just look at the gross profit for a second.
Okay.
They generated $807 million in gross profit, which translates to an 80.2% gross margin.
Wait, 80.2%. Let's just pause on that. For an infrastructure company processing the sheer volume of data they process, 80% margins are staggering.
It's incredible.
That means for every new dollar of revenue they bring in, the underlying compute, storage, and hosting costs actually deliver the software only eat up about 20 cents.
Exactly. The unit economics are pristine. But the metric that truly separates them from their peers is the free cash flow.
Let's hear it.
In Q1 alone, they generated $289 million in free cash flow. That is a massive 29% free cash flow margin.
Okay, a 32% top-line growth rate and a 29% free cash flow margin. If you use the classic rule of 40 metric.
Right, the SIRS benchmark.
Yeah, which for our listeners states that a healthy software company's growth rate plus its profit margin should equal 40. Datadog is sitting at 61.
Yeah, they are obliterating the benchmark.
How are they achieving growth and profitability simultaneously when almost every other software vendor has to structurally choose one or the other?
Well, it comes down to pricing power, driven by architectural superiority, combined with just an incredibly efficient go-to-market motion.
Unpack that a bit.
Sure, because their platform is cloud native and multi-tenant. They push updates and scale capacity without the massive overhead of maintaining legacy single-tenant environments.
Got it.
But the real secret to their efficiency is hidden in their customer cohort data. They aren't spending massive marketing dollars to acquire tens of thousands of low-value customers.
Right. I noticed that in the supplementary data. They ended the quarter with about 33,200 total customers. But the cohort driving the financial engine is highly, highly concentrated.
Yes, it is.
They have 4,550 customers generating $100,000 or more in annual recurring revenue. And that's up from 3,770 a year ago.
And management explicitly stated that those high-value customers, those whales, generated approximately 90% of the Q1 revenue growth.
90% of the growth from just over 4,000 customers. That concentration is fascinating. I look at that and immediately think about the classic land and expand motion.
Oh, absolutely.
Because, you don't walk into a Fortune 500 company and instantly sign a $500,000 annual contract.
Never happens.
Right. You land with a small team, maybe selling one infrastructure monitoring module for 20 grand. And once the engineers see the value, it spreads laterally to other departments.
Like wildfire.
But for 4,550 companies to be spending over $100,000 annually, it tells me that Datadog isn't just an external vendor anymore. They have become the literal central nervous system for these enterprises.
Precisely. When your spend crosses that six-figure threshold, you aren't just buying a tool, you are making a strategic architectural decision.
Right.
It implies that your engineering teams are building their daily workflows, their alerting protocols, their incident response playbooks, all entirely around Datadog's API and dashboards.
So the switching costs become astronomically high.
Exactly. which protects that 80% gross margin because the customer simply cannot afford the operational downtime required to rip the software out.
Okay, so we have a company hitting a $1 billion quarterly run rate, accelerating growth to 32%, maintaining an 80% gross margin, and printing massive free cash flow, all driven by sophisticated enterprise customers aggressively expanding their deployment.
It's a perfect storm.
But numbers are just the exhaust of the underlying business engine, right? So let's transition to section 2. We have to look under the hood at the story behind these numbers.
We do.
What are these customers actually buying that makes them write larger checks right now?
And to figure that out, that requires analyzing the two massive secular shifts highlighted on the call. First, the aggressive push for platform consolidation, and second, obviously, the explosive emergence of the AI infrastructure market.
Right. Let's start with consolidation. CEO Olivia Pomel provided usage statistics that illustrate the depth of their platform penetration.
Yeah, and the numbers are telling.
I have those numbers right here. 56% of their customers now use 4 or more Datadog products. 35% use 6 or more products, and a full 20% of their customer base, which equates to over 6,600 companies, uses 8 or more different products from the Datadog ecosystem.
Yeah, it is wild.
Furthermore, out of their 26 total modules, 5 of them are individually generating over $100 million in annual recurring revenue each.
That product density is really the core of the bull thesis here.
Yeah.
You have to understand the historical context of enterprise architecture.
Right, how things used to be built.
Yeah, exactly. Over the last decade, as companies migrated from on-premises data centers to the cloud, engineering teams adopted a highly fragmented approach. They bought a specialized open-source tool for server monitoring, maybe a different proprietary software for application tracing.
A completely separate vendor for network security.
Yes. And maybe a fourth tool for digital experience monitoring on the front end.
The classic best-of-breed approach. I mean, on paper, it sounds great. You get the specialized tool for the specific job.
On paper, yes. In practice, it creates a deeply siloed environment. The database team is looking at one dashboard, the network engineers are looking at another, and the security team is in a third.
And none of the data models align.
None of them.
So we go back to our hospital analogy from the intro. The doctors are literally speaking different languages. When a major e-commerce site crashes on Black Friday, the front-end monitoring tool says the website is down, but the server tool says the CPU usage is fine.
While the database tool shows a locked table.
Exactly. The engineers are forced to manually export logs, put them in a spreadsheet, and try to line up the timestamps to find out what actually broke. It's an agonizing process.
This is what the industry calls tool sprawl. And enterprise CTOs are just absolutely exhausted by it.
Like that.
They're realizing that maintaining a patchwork of open source tools is a false economy. I mean, sure, the licensing might be free, but the human capital cost of having elite engineers maintain integrations, patch security vulnerabilities, and suffer through prolonged outages, it's crippling.
So Datadog's entire pitch is solving that exact problem. They walk in and say, decommission those 6 fragmented tools, deploy our single unified agent, and we will automatically correlate your network data, your application traces, your database queries, and your security logs into a single unified data model.
Yep.
That explains why 20% of their base is using 8 or more products. It's not just random feature creep, it's an intentional architectural consolidation.
And management detailed several specific go-to-market wins that perfectly illustrate this mechanic. Let's look at the Fortune 500 bank they highlighted.
Oh, yeah.
This bank signed a 7-figure annualized expansion to fully replace a legacy log management vendor with Datadog's FlexLog product.
I want to dig deeply into this specific win because, log management is a notoriously brutal expense for large enterprises. Why did a Fortune 500 bank rip out an entrenched legacy vendor just to use Datadog for logs?
Well, to understand this, you have to look at the underlying architecture of legacy log management. Think of logs as the immutable digital paper trail of everything that happens inside a system.
Okay.
Every user login, every microservice call, every database query generates a line of text. For a Fortune 500 bank, that translates to petabytes of unstructured data every month.
Just some massive, endless fire hose of text.
Exactly. And legacy vendors force you to ingest all of that data, parse it, index it, and store it in what's called hot storage so it's instantly searchable.
Which sounds expensive.
Oh, it is. The indexing compute power and hot storage are incredibly expensive.
Yeah.
The bank was likely paying millions of dollars a year to index petabytes of routine informational logs that no human being would ever look at.
Right.
unless there was a specific audit or an incident.
So you're paying a premium to store and index data you don't even want, just in case you might need it someday?
Precisely.
Okay.
But Datadog recognized this architectural flaw, and they built FlexLog. FlexLog fundamentally decouples storage from compute.
Interesting.
It allows the bank to route all of those petabytes of logs into cheap, cold storage, like an Amazon S3 bucket, for a fraction of the cost.
Yeah.
They don't pay to index it.
Okay.
But if a security incident occurs, FlexLog allows them to instantly, dynamically spin up compute power to query that cold storage on demand.
Wow. That is a brilliant piece of engineering. So you get the compliance and security of keeping everything, but you only pay the heavy compute tax on the, 1% of data you actually need to investigate?
Yeah.
No wonder the bank signed a 7-figure deal. The software essentially pays for itself by slashing their AWS infrastructure bill.
It's an immediate, hard dollar return on investment. And we saw a similar theme with the global hedge fund management mentioned.
Right.
They signed a massive deal to replace their entire on-premises open source monitoring stack. They were operating thousands of hosts and network devices.
Now, a hedge fund is a fascinating use case because their tolerance for latency is virtually zero.
Yep, zero.
I mean, in high-frequency trading, if a network switch introduces a 2-millisecond delay, the trading algorithm is suddenly executing on stale market data. That's a disaster.
Exactly. And the open source solution they were using simply couldn't scale to provide the real-time correlated visibility required. The engineering team was likely spending more time managing the monitoring software than they were managing the actual trading infrastructure.
Which is crazy.
So Datadog came in and provided a unified view across their cloud and on-premises environments, allowing them to instantly correlate network latency spikes with application performance degradation. They expanded to 11 Datadog products simultaneously.
Moving from 0 to 11 products in one motion is incredibly aggressive.
It is.
Then there was the Fortune 500 insurance company. They consolidated 3 legacy application performance monitoring tools into Datadog. The transcript noted this was specifically to stop long outages, process errors, and fraud incidents.
The key phrase there is long outages.
Why is that?
Well, when an insurance company is using 3 different APM tools, it means different development teams built different applications in total isolation.
Okay, so the auto claims team used Tool A.
The life insurance team used Tool B, and the core underwriting engine used Tool C.
Got it.
So when a user tries to bundle a policy on the website, the data request crosses all 3 environments.
Right.
If the transaction fails, none of the 3 tools have end-to-end visibility. They can't trace the request across the boundaries.
Ah, I see.
But Datadog provides distributed tracing. It tags the specific user request the moment it enters the network and follows it through every single microservice, instantly highlighting exactly which line of code in which environment caused the failure.
It completely changes the engineering culture from reactive firefighting to proactive optimization.
Absolutely.
And we see this consolidation thesis playing out globally. Management called out a travel group in the Asia-Pacific region that consolidated 6 legacy tools and a Latin American fintech company that completely overhauled its front-end monitoring to prevent reputational damage from mobile app crashes.
And all of this non-AI growth, this core cloud migration and vendor consolidation business, accelerated to the mid-20s% year over year, up from 19% last year.
Which is so important to highlight.
It really is. It proves that the foundational business is structurally robust, completely independent of the AI hike cycle.
That is a critical point for our retail investors. If you strip out all the artificial intelligence tailwinds entirely, Datadog is still a hyper-growth, highly profitable company just by acting as the apex predator of legacy IT budgets.
Just eating them up.
But as we analyze the underlying business drivers, we absolutely cannot ignore the AI kicker. I mean, this is where the Datadog narrative transitions from an excellent software business into a genuinely futuristic infrastructure play.
Yeah, and management provided very specific data points on their AI exposure. Currently, 6,500 customers are actively using Datadog's various AI integrations.
Okay.
That represents roughly 20% of their total customer base.
But the weighting of those customers is what matters, right?
Yeah.
Management noted that those 20% of customers represent about 80% of Datadog's total annual recurring revenue.
Yes. It is a massive concentration of capital. The companies that are actively building and integrating AI are not just the small startups. They are Datadog's absolute largest, highest-paying enterprise whales.
Right.
And Datadog is capturing this market from 2 distinct vectors, which Palmo categorized as AI for Datadog and Datadog for AI.
I want to break down both of those vectors because they solve completely different problems for the customer. Let's start with AI for Datadog. This is essentially how they are weaponizing large language models to make their own platform more powerful for the human engineer.
Right.
And the primary example they gave was a product called Bits AI Security Agent.
Yeah. So security operations centers are typically overwhelmed by alert fatigue. They receive thousands of low-level security signals every single day.
Just constant noise.
Exactly. A human engineer has to manually look at an alert, query the logs, check the IP address against a threat database, and determine if it's a false positive or a legitimate breach. Pommel noted that the Bits AI security agent autonomously triages these signals.
But I want to understand the mechanics here. It isn't just a chatbot summarizing a log file, is it? How does it actually reduce an investigation that used to take 3 hours down to 30 seconds?
It uses a specialized agentic architecture. When an anomalous signal fires, say, a user logging in from an unfamiliar geographic location and immediately attempting to access a sensitive database bits, AI doesn't wait for a human.
It just acts.
Right. It instantly queries the historical telemetry to see if this user has ever exhibited this behavior.
Yeah.
It cross-references the network traffic to see if data is being exfiltrated.
Yeah.
It analyzes the specific database queries being executed. It compiles all of this context, determines the severity of the threat, and generates a pre-written remediation script, like a firewall rule, to block the IP, presenting the entire package to the human engineer for a one-click approval.
So it essentially automates all the investigative grunt work.
Completely.
From an investment perspective, the ROI on that is undeniable. If you are a company paying an elite security engineer $200,000 a year, you don't want them spending 3 hours manually grepping through log files.
No, you want them making strategic decisions.
Exactly. Software that gives you a 360-degree productivity boost pays for itself instantly.
Exactly. AI for Datadog deepens their moat by making their platform the most efficient place to work. But the second vector, Datadog for AI, is arguably much more important for their long-term valuation.
Let's talk about that.
This vector is entirely about expanding their total addressable market by providing the monitoring infrastructure for the companies building the foundational AI models.
And this brings us to what I think is the absolute most critical revelation in the entire earnings call. The architectural shift from monitoring AI inference to monitoring AI training.
We really have to unpack the difference between the two because the compute requirements and therefore the monitoring requirements are vastly different.
Right. Historically, Datadog's AI exposure was heavily weighted toward inference.
Yes.
Think of inference as the AI model actually doing its job in the real world. When you type a prompt into an LLM, the model uses its pre-trained weights to infer the correct answer and generate text. Datadog monitors that transaction.
They make sure the API gateway is responsive, they track the latency of the token generation, and they monitor the cost per query.
It is essentially standard application performance monitoring, just applied to an AI endpoint.
Exactly. But training the foundational model is a completely different universe of computing. You aren't just sending a text prompt to a server. You are taking trillions of parameters of raw data and running immense mathematical calculations to teach the model how to think.
Trillions of parameters.
Yeah. Training a frontier model requires orchestrating massive synchronized clusters of specialized hardware. We are talking about tens of thousands of NVIDIA GPUs, like the H100s, networked together in massive server farms.
And these training runs operate continuously for months at a time. They consume the power output of a small city, and they cost hundreds of millions of dollars in compute time alone.
It's massive scale.
And this is where Datadog's breakthrough happened. They announced they landed a 7-figure deal and an 8-figure annualized deal with 2 of the world's largest AI research labs. The hyperscalers actually building these massive models.
An 8-figure deal means a single customer is paying them over $10 million a year. And they aren't paying that to monitor simple API calls. They are paying for deeply specialized GPU monitoring.
But why is monitoring a GPU cluster so difficult that an AI research lab will pay $10 million for an external tool?
Because of the synchronous nature of AI training. In a standard cloud environment, if one server goes down, the load balancer just routes traffic to another server. No big deal. But when you are training a massive neural network, the GPUs are constantly sharing parameters with each other over high-speed interconnects like NVLink or InfiniBand. They operate in lockstep. If a single GPU out of 20,000 starts to overheat and thermal throttles its clock speed, it creates a massive bottleneck. The entire cluster has to slow down and wait for that one lagging GPU to finish its calculation before the global training step can proceed.
Oh, wow. So a 5% degradation in just one physical chip can cause a cascading failure that drops the utilization rate of a $500 million cluster by 20%.
Exactly. The financial bleed is catastrophic. You are burning millions of dollars in electricity and compute time while your GPUs sit idle, waiting for data. Datadog deployed specialized agents that monitor the granular thermal dynamics, the power draw, and the interconnect bandwidth between the GPUs to instantly identify bottlenecks and stragglers so they can be isolated and replaced without stalling the entire multi-month training run.
But wait, I have a massive structural question here.
Go ahead.
We are talking about the hyperscalers, the Amazons, the Googles, the Microsofts, the absolute titans of the technology world. They have tens of thousands of the most elite software engineers on the planet on their payroll.
They practically invented distributed computing.
Exactly. So why on earth are they paying Datadog 8 figures a year to monitor their servers when they could easily build these dashboards themselves?
This is the exact question an analyst asked during the Q&A, and Olivier Pommel's response was incredibly revealing regarding the current state of the tech industry. He explained that historically, hyperscalers absolutely default to building internal tooling. It's in their DNA. But the current generative AI arms race has completely warped their standard operational calculus.
It's the speed of the race.
Precisely. These hyperscalers are locked in an existential fight for dominance over the next decade of computing. Getting a frontier model to market 1 month before a competitor is worth billions of dollars in enterprise contracts and market capitalization. Every single elite systems engineer they possess needs to be relentlessly focused on optimizing the core AI model itself.
It's all about opportunity cost. If Google pulls 50 of their best infrastructure engineers off the Gemini project to go build an internal GPU temperature monitoring dashboard, they lose crucial momentum on the model itself. The internal dashboard isn't the core differentiator, the intelligence of the model is.
Exactly. Building a world-class observability platform from scratch takes years of iterative engineering. The hyperscalers literally cannot afford the distraction right now, so they swallow their pride, bypass their internal build-it-here culture, and buy the absolute best off-the-shelf solution available, which is Datadog.
That dynamic is the ultimate validation of Datadog's status as the premium picks and shovels play in the AI gold rush. They aren't placing a highly speculative multi-billion-dollar bet on trying to build the smartest AI model.
No.
They are selling the mission-critical foundational tools to every single combatant fighting in the trenches. If the biggest tech companies on Earth determine that your product is too complex to replicate quickly in-house, your economic moat is impenetrable.
And we see that translating directly into usage. Datadog noted that the number of diagnostic spans sent to their LLM observability product nearly tripled quarter over quarter. They're successfully monetizing the entire underlying ecosystem of the AI boom.
So the narrative driving the numbers is incredibly cohesive. You have the core non-AI business accelerating due to intense vendor consolidation, driven by the desire to eliminate tool sprawl.
Right.
And layered on top of that, you have a rapidly expanding AI TAM as they transition from monitoring simple inference endpoints to securing 8-figure contracts monitoring the core GPU training clusters of the world's largest tech companies.
The foundational setup is phenomenal. But as investors, we know that historical data, no matter how pristine, is only half the equation. The market is entirely forward-looking. A massive Q1 performance only matters if it sets the stage for an even larger Q2 and beyond, so we have to rigorously analyze the management guidance.
Right. Let's transition to Section 3. How did CFO David Opsler and the management team frame the expectations for the rest of 2026?
Let's lay out the precise numbers. For the Q2 2026 outlook, management guided for revenue to land in the range of $1.07 billion to $1.08 billion.
Oh.
If they achieve the midpoint of that range, it represents a year-over-year growth rate of 29% to 31%.
Guiding for roughly 30% growth on a $1 billion quarterly baseline implies they are expecting the intense demand environment we just discussed to persist without any macroeconomic degradation. What about the profitability guidance?
Non-GAAP operating income is guided at $200 million to $235 million, which translates to an operating margin of 21% to 22%.
Solid.
It's important to note that Opsler specifically mentions includes an estimated $15 million in structural costs for hosting their upcoming D-H user conference in New York City. So the underlying margin is actually slightly stronger. Earnings per share is expected to come in between $57 and 59 cents.
And did they revise the full year outlook based on the Q1 outperformance?
They did. For the full fiscal year 2026, they raised their revenue guidance to a range of $4.3 billion to $4.34 billion, representing 25% to 27% year-over-year growth. Full-year operating income is targeted at $940 million to $980 million, keeping the margin profile in that highly profitable 22% to 23% band.
The numbers themselves are undeniably strong. But I was reading the transcript of the analyst Q&A, and Opsler used a very specific phrase regarding how they constructed this guidance.
Oh, I know what you're going to say.
He repeated it several times, and it clearly caught the attention of the institutional analysts. He referred to their conservatism caveat.
Yes. Opsler explicitly stated that their core philosophy for building guidance remains unchanged. They extrapolate based on recent usage trends, but intentionally apply a layer of conservatism to account for unforeseen macroeconomic shocks. Oh. But he added a highly specific new detail.
What was it?
He stated that they applied a higher degree of conservatism, specifically to their absolute largest customer.
I want to break down the game theory of this statement. Why would a sitting CFO get on a public earnings call with billions of dollars of market capitalization on the line and explicitly broadcast to Wall Street, hey, we have this one massive customer and we are deliberately assuming in our financial models that they're going to spend significantly less money with us next quarter than our internal telemetry suggests they actually will?
It is a masterful piece of expectation management, commonly referred to as sandbagging, but done with a highly specific strategic purpose. When Datadog lands these mega whale customers, like the 8-figure AI research labs we discussed, the revenue recognition isn't a simple flat monthly fee. Datadog operates on a consumption-based pricing model.
Okay.
The customer commits to a massive baseline, but their actual bill fluctuates based on the volume of data they ingest and the compute resources they consume.
Right. So if an AI lab suddenly spins up 10,000 new GPUs for a massive training run, their Datadog consumption spikes exponentially in real time.
Exactly. And because these AI training workloads can be highly variable and experimental, predicting the exact month that massive spike in consumption will hit the profit and loss statement is incredibly difficult. Management doesn't want to bake a theoretical massive spike into their public guidance, miss the target because the AI lab delayed their training run by 3 weeks, and watch the stock plummet.
So they aggressively de-risk the quarter, by explicitly telling Wall Street that they are heavily discounting their largest customer's projected spend. They intentionally lower the bar. They establish a baseline of 30% growth, assuming their biggest customer essentially does nothing.
And if that customer does ramp up their usage, as the architectural dynamics suggest they will, Datadog will post a massive top-line beat in Q2, which is exactly what institutional investors look for to justify expanding the valuation multiple.
Makes total sense.
An analyst from Scotiabank actually pressed Opsler on this exact point during the Q&A, asking if this higher degree of conservatism represented a fundamental change in their forecasting methodology. Opsler definitely reiterated that the methodology is the same, but because this single customer is now so disproportionately large, applying the standard internal discount rate has a highly pronounced visible effect on the aggregate guidance numbers.
Reading between the lines, management is brimming with confidence about Q2, but they are leaving themselves an enormous margin of safety.
Definitely.
Now, there's another financial metric buried deep in the guidance section that I found structurally fascinating. It has to do with how Datadog is physically operating their business amidst the most capital-intensive technological arms race in history.
You are referring to their capital intensity metric.
Yes.
David Opsler noted that they expect capital expenditures, along with capitalized software, to remain incredibly low, just 4% to 5% of their total revenue for fiscal 2026.
I want to highlight the genius of this dynamic for everyone listening. We just spent 20 minutes detailing how the generative AI boom requires hyperscalers to spend tens of billions of dollars on physical hardware. They are building massive data centers, securing dedicated nuclear power plants, and buying every single NVIDIA H100 chip they can physically source.
It's an infrastructure build-out like we've never seen.
Right. And Datadog sits at the absolute epicenter of this AI boom, generating massive revenue by monitoring all of this equipment. Yet Datadog themselves are only spending 4% of their revenue on physical capital expenditures.
It highlights the ultimate structural advantage of Datadog's cloud-native architecture. Datadog does not own physical server farms. They don't own warehouses full of GPUs.
Which is incredible.
When a global hedge fund or an AI research lab signs a contract and suddenly wants to send Datadog an extra petabyte of telemetry data per day, Datadog doesn't have to go buy new hardware. They simply utilize their elastic architecture to dynamically spin up more capacity on Amazon Web Services or Google Cloud.
So they are entirely shielded from the crippling depreciation costs of the infrastructure hardware wars.
Completely shielded. If you are an AI lab building a model, your CapEx is astronomical because hardware is your primary constraint. Datadog just sells the lightweight software agent that monitors that hardware. Their capital intensity remains flat at 4%, while their revenue from these heavily capitalized AI customers skyrockets.
Wow.
They capture the immense financial upside of the AI boom without taking on a single ounce of the physical hardware risk. It is an incredibly highly leveraged, asset-light business model.
It is the perfect asymmetric bet on AI infrastructure. But while they are rigorously controlling their physical CapEx, they are actively deploying their operating expenses into expanding their total addressable market through massive compliance and infrastructure milestones. The management team highlighted two specific new horizons during the call.
Yes. First, they announced the opening of a new localized data center in the United Kingdom. And second, they officially received their FedRAMP High certification from the United States federal government.
Let's analyze the UK data center first. Datadog is a cloud software company. Why do they need to physically open a data center in a specific country when their platform is already accessible globally via the internet?
It entirely revolves around the complex legal reality of data sovereignty. As cloud adoption aggressively accelerates in highly regulated industries, like European retail banking, national healthcare systems, or defense contractors, sovereign governments are passing strict data privacy laws. These laws explicitly mandate that sensitive citizen data, or government telemetry, cannot physically cross international borders.
So if a British bank wants to use Datadog to monitor its customer transaction databases, Datadog must guarantee that the telemetry data never leaves the UK.
Exactly. Prior to this announcement, Datadog was structurally locked out of a massive segment of the European regulated market. By investing the operating expense to stand up a localized, fully compliant UK data center, Datadog instantly removes the primary legal barrier.
That opens so many doors.
They can now actively sell into every major British enterprise and government agency that desperately wants to modernize its observability stack, but was previously prevented from doing so by data residency laws.
It's an instant expansion of their geographic TAM. But I want to focus intensely on the second announcement because, from a long-term enterprise value perspective, this is the hidden gem of the entire earnings call. They achieved FedRAMP High certification. How significant is that specific designation?
In the realm of public sector software procurement, FedRAMP High is essentially the ultimate golden VIP pass to the most lucrative, stable, and highly classified contracts on the planet.
We are talking about the Department of Defense, the Department of Homeland Security, the Veterans Administration.
Precisely. The U.S. federal government classifies its data workloads based on the potential impact of a security breach. A high impact level means that the loss of confidentiality, integrity, or availability of the data could result in severe or catastrophic adverse effects on organizational operations, organizational assets, or individuals.
So national security level stuff.
Yes. To even be legally permitted to bid on a contract to touch that caliber of data, a software vendor must achieve FedRAMP High.
And the barrier to entry is notoriously brutal, isn't it?
It is bureaucratic trench warfare. It requires implementing over 400 specific security controls, mandating FIPS 142 validated encryption at every layer, and establishing continuous real-time monitoring of the software architecture. It requires years of dedicated engineering effort and millions of dollars in third-party audits.
Wow.
A scrappy new observability startup with a great user interface cannot sell to the Pentagon because they simply do not have the capital or the infrastructure to achieve FedRAMP High.
So the certification itself is a massive economic moat?
Yeah, an almost impenetrable moat. Datadog now has the ultimate clearance to migrate federal agencies off their legacy on-premises systems and onto the Datadog cloud for their most highly sensitive workloads. Management explicitly noted on the call that they are aggressively expanding their public sector go-to-market teams to capitalize on this. This represents a multi-billion-dollar total addressable market that is completely insulated from commercial macroeconomic fluctuations.
Because the federal government does not cancel defense IT contracts just because interest rates tick up.
Exactly.
So if we synthesize the guidance and the forward-looking strategy, the financial guidance is structurally conservative, intentionally setting up future beats. Their CapEx remains near zero, perfectly shielding them from the brutal hardware wars while still monetizing the AI boom. And they just successfully unlocked sovereign European data markets and the impenetrable U.S. military-industrial complex as entirely new customer bases.
The structural setup for the remainder of 2026, and frankly the rest of the decade, is exceptionally robust.
Which brings us perfectly to Section 4, the final synthesis of our deep dive, the bottom line. We have parsed the headline numbers, rigorously analyzed the architectural shifts driving those numbers, and unpacked the strategic nuance of their forward guidance. It is time to translate all of this complex data into a definitive, actionable takeaway for you, the retail investor who is currently evaluating their portfolio.
Let's lay out the thesis plainly. Based purely on the empirical evidence provided in the Q1 2026 earnings call, the overall verdict on Datadog is highly, unequivocally bullish.
Let's summarize the core pillars of that bull case for our listeners.
First, they possess a highly durable dual-engine growth mechanism. Engine number one is the massive, ongoing secular tailwind of legacy cloud migration and platform consolidation. Companies are actively abandoning fragmented open-source architectures to consolidate onto Datadog's unified platform. They do this to slash the human capital cost of maintaining multiple tools and to drastically reduce catastrophic downtime. This core, non-AI business is actually accelerating its growth rate.
And engine number two is their dominance in the bleeding-edge AI wave.
Exactly. They have successfully transitioned from merely monitoring basic cloud endpoints to securing massive 8-figure mission-critical GPU monitoring contracts for the world's largest hyperscaler training labs. They are the essential picks and shovels of the generative AI revolution.
Furthermore, their financial foundation supports the aggressive narrative. They are achieving top-line growth acceleration at a massive $1 billion quarterly scale, which defies typical software physics. They are actively expanding their operating margins and printing nearly $300 million a quarter in pure free cash flow. They hold a pristine balance sheet with $4.8 billion in cash and marketable securities. And critically, their customer retention metrics prove that the product fundamentally works.
The retention data is the ultimate arbiter of software quality. Their trailing 12-month gross retention remains firmly in the mid to high 90s. That means virtually no enterprise that integrates Datadog ever uninstalls it. The switching costs are too immense and the value is too high. And their net revenue retention is in the low 120s.
That NRR figure is crucial. It means the customers who stay aren't just passively renewing their contracts. They are actively increasing their spend with Datadog by over 20% every single year, adopting more modules and ingesting more data.
So the actionable takeaway for you, the listener, is this. If you are holding or considering D2G, you have to accurately categorize what you are buying. You are not buying a highly speculative AI startup that hopes to figure out a monetization strategy in 5 years. You're looking at an apex predator in the enterprise software ecosystem.
I love that phrasing.
In the broader AI landscape, while venture capitalists and retail investors are placing incredibly risky bets trying to guess which foundational AI model will ultimately win the wars, will it be OpenAI, Google, Meta, or Anthropic? Datadog operates entirely above the fray. They are positioning themselves as the indispensable utility provider. They ensure that all of those models actually run efficiently. It is a premium, mission-critical asset, and its pristine financial performance completely justifies its premium valuation multiple.
I completely agree with that assessment. I want to connect this back to a fundamental framework I use when evaluating enterprise software companies. I always ask myself one core question regarding the product's utility. Does this software solve a hair-on-fire problem? Or is it simply a nice-to-have vitamin?
A vitamin makes the business slightly healthier. A painkiller stops the bleeding. Datadog is definitively not a vitamin.
It is the ultimate painkiller. Think back to the architectural examples we discussed. When a Fortune 500 bank's core transaction processing system goes down, or when a quantitative hedge fund's trading algorithm starts failing due to an invisible network latency spike, the chief technology officer's hair is quite literally on fire.
Oh, absolutely.
That outage costs the firm millions of dollars per minute. The board of directors is demanding answers. Institutional clients are panicking.
The psychological stress inside a network operations center during a Sev1 outage is palpable. Careers are made or broken in those moments.
Datadog is the platform that extinguishes the fire. Or, more accurately, proactively identifies the anomalous telemetry and prevents the fire from ever starting. It is mission-critical structural infrastructure. If you tell a Fortune 500 CEO that they are facing a macroeconomic headwind and they must immediately cut their IT budget by 10%, they will ruthlessly cut their project management software. They will delay upgrading laptops. They will slash their corporate travel budget. The absolute last thing they will ever do is unplug the centralized observability system that monitors their production servers, because doing so means flying entirely blind.
That is the exact mechanism driving their mid to high 90s gross retention. The existential risk of operating a modern distributed cloud environment without unified visibility is simply too catastrophic to consider.
We have thoroughly established the bull case. The financial metrics are pristine, the product narrative is actively accelerating, and the economic moat is significantly widening. But before we conclude this deep dive, I want to step slightly outside the immediate financial modeling. We've analyzed the explicit data from the transcript, but there is a conceptual thread running through Olivier Pommel's answers during the Q&A session that, frankly, points to a paradigm shift in the fundamental nature of the IT industry.
You're referring to the discussion surrounding the long-term evolution of observability in an AI-native world.
Exactly. I want to leave you, the listener, with a final, highly provocative thought to consider as you build your long-term thesis on infrastructure software. During the Q&A, an analyst asked Pommel about the future of the platform when autonomous AI agents begin handling the actual triaging of incidents instead of human engineers.
Right.
And Pommel explicitly noted a stratospheric increase in non-human AI agents actively using the Datadog platform via their Model Context Protocol, or MCP, servers.
This fundamentally alters the definition of what a user is. Datadog is actively building and facilitating tools like the BITS AI SRE agent. SRE stands for Site Reliability Engineer.
Let's track the historical progression here. Historically, Datadog sold a highly sophisticated dashboard. A human IT professional sits in a network operations center, stares at the Datadog dashboard, sees a red flashing spike indicating a server memory leak, and then uses their human brain and fingers to open a terminal, write a patch, and reset the server. Datadog was the diagnostic tool. The human was the mechanic.
But the architectural paradigm is shifting violently.
It is a complete inversion. Datadog is facilitating an ecosystem where AI agents don't just detect the bug. Using the MCP server, a large language model connects directly to Datadog's API. It pulls the stack trace. It autonomously investigates the root cause. It drafts the necessary code patch in GitHub. And it deploys the fix to the production server without a human being ever clicking a mouse. Management literally noted that these autonomous BITS AI SRE agent investigations more than doubled in just a 3-month period.
What is truly fascinating here is the underlying implication for their financial model. Datadog charges based on consumption, the volume of data ingested, and the API calls executed. They do not care if a human engineer is logging into the dashboard or if a fleet of autonomous AI agents is hitting their API 10,000 times a second to perfectly optimize a massive server farm in real time. In fact, an autonomous, hyper-vigilant AI agent will likely consume vastly more telemetry data and execute significantly more API queries than a human team ever could, exponentially driving up Datadog's consumption revenue.
And that is the provocative thought for you to take away from this analysis. Over the next decade, as you evaluate your portfolio allocations, you have to ask yourself a foundational question about the companies you own. Are you investing in a software company that merely builds a faster, prettier diagnostic dashboard for the human IT department? Or, by holding Datadog, are you actually investing in the underlying automated AI-driven entity that will eventually replace the manual functions of the human IT department entirely?
If the observability software seamlessly evolves into the actual engineer executing the fixes, the enterprise value of that software platform becomes nearly incalculable.
And that brings our analysis full circle. Because if Datadog is successfully building the automated, autonomous IT department of the future, then they aren't just selling the hospital's diagnostic EKG machine anymore. They're selling the EKG machine, the robotic surgeon that instantly interprets the scan, and the automated scalpel that perfectly fixes the internal bleeding before the patient even registers that they are hurt.
And they're successfully charging the enterprise an absolute premium for running the entire hospital.
Exactly. Thank you for joining us for this deep dive into Datadog's Q1 2026 earnings call. We strongly encourage you to take the core metrics we unpacked today. The rare revenue acceleration at $1 billion scale, the elite 29% free cash flow margins, the intense architectural consolidation trend, and their dominant positioning in the AI training TAM, and ruthlessly overlay them onto your own portfolio holdings. Challenge your current investments to see how they stack up against an execution engine operating at this level of precision. Stay curious, keep rigorously analyzing the underlying data, and we will see you on the next deep dive.